Hey kids, Uncle Doug here. Gonna drop some mortgage knowledge and some real estate knowledge on you today. You can find me at I Dig Mortgages. That's my handle on all social media platforms. Call me, text me, email me. I will respond as quickly as I can. I'm a very responsive guy, and I want to help you get into a house. So, the question of the day, should I wait until rates drop? There's an awful lot of people on the sidelines right now, a lot of people that I have pre-approved, all waiting for the rates to get better. Is that a good idea? Let's dig in. So what I did here from our friends at Old Republic Title is they gave me access to this tool. We pulled a couple of different reports for Henderson, all of Clark County from Mesquite all the way down to Laughlin. And then we also looked at Las Vegas proper to look at what's the market doing. Is the market in equilibrium? If the market was here, it would pretty much be an equilibrium market where it wouldn't be a buyer's market and it wouldn't be a seller's market. Everything would be equal. Right now, though, it is a seller's market, so that the market is out of equilibrium. This means we have more demand than we have supply. We have more buyers than we have houses. So when there are people competing for a finite amount of resource, that drives prices upwards. Okay? And this is with the rates where they are. What do you think is going to happen when rates get even lower? Will some people decide to sell their houses? Maybe. Maybe. But you can definitely count on more competition when you're buying, right? Because let's look at this. Whether it's Henderson, we look at Henderson here. You can see here's where the rates started climbing in 2022. Pricing dropped. I started screaming from the rafters right here, screaming as loud as I could. Get in the market. If anyone followed my advice, those who followed my advice, they rode this wave all the way up to here. They made a killing. They look brilliant. Clark County in general, same thing, right? Prices dropped, and now it's climbing again, and it's already made up for its losses. And Las Vegas, same thing. It's back up to where it was, 692 to 690. So it has already made up the ground, and this is before the rates have even started to drop. Now, if you know who Barbara Cochran is, she's the blonde real estate titan on Shark Tank. She said very clearly in an article last month that if you think it's bad now, wait until rates drop by 1 point. It is going to be a feeding frenzy. Everyone's going to be trying buying that one house, and you're going to have 10 people bidding on it. What do you think that's going to do to prices? It's going to drive it through the roof. So for those of you who are more visual, I try to make a spreadsheet for you just to kind of show you what this really looks like. Now, let's say we're looking at a $500,000 house. You put 5% down, $25,000. That means your loan is $475,000. You with me? Great. Now, if you finance a house at $475,000 at a 7.5% rate, your premium, or your principal and interest payment, so the payment on just the mortgage side of things, not counting taxes and insurances, we're not talking about EPRs, we're just talking about strictly the mathematics here of what a 7.5% rate on a $475,000 loan, the principal and interest is $33.21. If we wait for the rates to drop by, let's say, 1 point, your payment goes to $3,002 a month. That is a difference, a delta of $319,000. And if you extrapolate that at 12 months, it's $3,800 a year. $3,800 a year. Now keep in mind, the government lets you write off the first $750,000 of your loan amount. The interest on that is tax deductible. So depending on your tax bracket, this might be $3,000, maybe even less, maybe more, depending on your bracket. Okay? So you're saving $3,000 in payment when the rates drop. But a lot of you are renting properties right now where you're paying 100% interest basically because you're paying rent and getting no benefit. You get no appreciation, you get no write-off. So you're paying 100% interest and you're paying maybe $2,000 or $3,000 a month for rent times 12 months. $24,000 in rent that you just paid for your landlord's rent. Awesome, right? So now we've got this $3,000 savings, if you will, even though we already know that's a loss. But it gets even worse if you wait. Because if you wait, we know that in Nevada, for example, that we estimate that in general, and again, real estate is localized, so there's going to be a lot of areas that go up even higher than this, and there's going to be some areas that are lower that are going to bring the ratio down, or the percentage down. But we're estimating that there's going to be a 5% appreciation this year and 20% over the next 5 years. So let's look at this in real terms. If you bought today at $500,000, you put your 5% down, you are going to now own a house worth $500,000. If you wait for a year, that same house is going to be worth $525,000 to $550,000, realistically. In some areas, it could even be more. Some areas, it might stay the same. But in general, we know if you're buying in a lot of the upper end areas, the nicer up and coming areas, Henderson, the southwest area, Summerlin for sure, the Aliante area, Centennial Hills, any of those areas, the whole west side pretty much at this point, from Summerlin, South Summerlin, we're going to see appreciation. So you can either buy now and refinance if rates drop, or you can wait a year, piss away a year's worth of rent, maybe save this, but you keep in mind you just pissed away $2,400 or more in rent. So are you really saving anything? No, you're really not. You just pissed away $21,000 if you saved that. But then you have to compound this problem, that you're now buying a house that's $25,000 to $50,000 higher than it was today. So by waiting, you maybe shelter this, you piss away $24,000 or more money in rent, $24,000 or more in rent, and you're going to buy the same house next year for $25,000 to $50,000 more, because ultimately the market is going to increase, and when it does, only one of two things happen. If you bought today and you're brilliant, your net worth goes up by $25,000 to $50,000 if the comps in your market dictate that your house goes up in value, your net worth goes up in value. Brilliant. Or you can wait and you end up paying that money to the seller, so you're going to pay more for the house, and you're going to need more down payment of $1,250 to $2,500 down, because as things go up, down payments go up. You with me? You picking up what I'm putting down? Get in the game. Reach out to professionals like myself. I've been in the game a long time. I got in the game in the late 90s. I've been a realtor, a property manager, a certified residential appraiser, builder, developer, homeowner, investor, and now mortgage banker. I'm here to help you use my knowledge to avoid any missteps and to make a wisest decision as possible. And I'm telling you, this is the time to get in the game. Get off the sidelines. All you're going to do is let more competition get at the trough with you, and that's going to drive up prices. Again, Uncle Doug, dropping knowledge, be the change you want to see in the world. You can find me at I Dig Mortgages, and all my contact information is here. Have yourself a phenomenal day.